right. So for this last section, we're just looking at how are we going to make these decisions. We've talked about different ways to finance capital, finance debt, and companies have to decide, what's the best way, whether it be the bonds or loans or selling stock, and realize how that affects their bottom line and their income. So, once you have all the numbers, you have the true accountant's job is really to help make decisions, lay out the facts, give them people to understand the dollars and cents behind the business, and maybe give different scenarios and different options to the owners, to the management team, whatever the case may be, so that the best decisions can be made. Okay, so the analysis part is the truly talented accountant's job, right? The numbers are there. That you've always got computers to help you with the numbers, but you've really got to understand the numbers, and that's why I like you guys to do things on paper. Just because I hope that you're understanding the numbers a little bit better when you're having to write it out. It slows you down a little bit. Okay, so this page is a good page to kind of look at different things that need to be considered. What's the cost of that capital going to be? You've got interest, you've got dividends that may have to be paid. You're going to lose ownership control if you are selling shares. So this is a good page. It's right here in front of you. You can pause, read through these different sections to kind of understand. There's a lot of different advantages and disadvantages to each one. Okay? All right. So basically what we're going to do is we're going to look at figuring out the financial leverage. Okay? When you are raising capital, borrowing money, you want to make sure that you're doing something with that money that will make your company more valuable, that your operating income is going to increase. Okay? If you're not doing that, then there's no point in borrowing money. You're just putting yourself in a hole. You've got to be able to know that if I'm borrowing money at 6%, that I'm going to make 15% more, right? So that covers your debt, okay? And that's what we're going to look at in this scenario, okay? And so you may, here you have got things about over-leveraged. Those may be terms that you hear if you're listening to people talk about business and companies worth and that kind of thing. Okay. This is just giving us an example of a company that may just use this as a comparison. This is their current amounts. If they add debt financing, if they add equity financing, these are the new amounts. How does this change our debt ratio? How does this change our ownership ratio? And then, the owners have to make decisions, or the company has to make decisions whether they're comfortable with those numbers. Okay? So again, these are the facts, and then decisions have to be made from those facts. And again, it could be the owners, it could be the managers, it could be the board of directors, just depending on the type of company that it is. Okay? So what we're going to do is go through a little scenario for KMT Stores. They want to renovate their stores, okay? And so what they're going to do is they're going to throw some numbers down, and they think that they may be able to increase their operating income by one of these percentages, okay? 6, 7, 8%, somewhere in there, okay? So they need to determine if this $100,000 is going to, if it, does it work at each of these percentages, basically, okay? The project costs $100,000. The company can issue bonds to finance 90% of the project, Okay, so we're going to send some bonds out there for 90%. The remaining 10% comes from internal sources. All right, they're determining that they're going to be able to serve more customers, and so because of that, they do feel like that they're going to be able to increase their operating income. They just need to know how much they really have to increase their operating income by to make this a feasible project. Okay? All right. So, now we've got this little table here. We got to figure out where all these numbers come from. Okay? So, they said that 90% is coming from bonds. Okay? That means the company has got to invest 10% of its own money. Okay? So 10%, and remember we're working with $100,000. Okay, so the 10% of that $100,000 is $10,000. So that's going to be the same for each scenario. Okay? All right. Then the operating income, they're talking about increasing the operating income by 6%. So what we're going to do is we're going to take the $100,000 times 6%. Okay, times 7%, and times 8%. Okay, so that number, of course, is 6,000. Oops, that's 7,000. And that's 8,000. Okay, so they're gonna, or they're increasing their operating income by 6% of that 100,000. Okay, if this 100,000 gives them 6% more, okay, then this is where the numbers are coming from. All right, so interest expense, the percentage of the bond is 7%, okay, and the bond is 90%, so that's $90,000. Times the 7%. Okay, so I hope you're keeping track of where that $90,000 is coming from, right? 10% here, 90% here, times 7%. So if we do that math, 90,000 times 7%, okay, and that's the bond percent, is 6,300, and that's the same each time. Okay, so here we're saying that we're going to increase by 6,000, but the interest is costing us 6,300. So right away we can see that we're losing money on that deal, right? We're doing some math here. Okay, so operating income minus equals the net income before taxes. And of course this is 700 and this is 1,700, doing that math. Okay, it's telling us that the income tax is 25%. Okay, so 25% of 300 is 75. Actually, let me put parentheses because that's really our accounting negative. And then 25% of 700 is 125, and 25% of 1,700 is 425. Okay, so now we're doing the math again. All right, and so really, I know these are two negatives, but we're not paying taxes on a loss, right? We're actually getting a kind of a discount on taxes because of a loss. So we are just going to straight subtract those. and it'll be a $225 loss instead of a $300 loss because of the tax. And then here we've got, what is that, 5? Oops, that's 175. I did the math wrong there. 175 and 525. Yeah. Okay, and then here 1275. Okay. So now we want to see, this is the big thing that we're looking for right here, return on investment. So we're going to take the net income divided by the investment. Okay, and that should be something, the ROI. That's something you should hear when you're talking about businesses. What's the return on my investment? Or you're talking about investing in something, right? People want to know that. All right, so when we do this math, negative 225 divided by 10,000, you're going to get a negative 2.3%. 525 divided by 10,000 is 5.3%. And 1275 divided by 10,000 is 12.8%. Okay, so now looking at these numbers, what are your viable options, right? And so basically that's what we just want to know here. KMT, viable options, 7% and 8%. 6% is a loss. Okay? Not viable. And you can word that much nicer than I just did, but that's just kind of a quick rundown on that. All right? Okay, and again, like I said, really the hard part of being an accountant is not doing the numbers, it's understanding the numbers, right? You can learn a pattern, and I know you guys do it. You learn a pattern, and you continue that pattern, you practice that pattern, but you really need to try to take it in and understand where those numbers are coming from and what they're doing, because that's the true value in being an accountant. Okay, there you go.